How much higher can the S&P 500 go before we run into very critical resistance? Today I'm going to do a detailed analysis of the S&P 500 and all of the sectors driving its performance and give you a great idea of what to expect in the coming months. First up, let's take a look at a daily chart of the SPX S&P 500 index. So let's crack open this chart and see what's going on in the stock market today. Alright, just a very quick reminder, I am running a Memorial Day sale for 50% off the Stocks Channel Trading Discord community and bank trade alerts, and you can find out how to get that discount in the description below as well as the comment section. On top of that, TrendSpider is also doing a Memorial Day sale for a 7-day free trial and up to 50% off their plans as well. Alright, so jumping over to a daily chart of the SPX, I think there's a very good chance the S&P 500 is going to try to climb to higher prices. And I just did a video on Friday of why I'm bearish on the NASDAQ 100 because a lot of those big tech companies are likely going to cool down soon. But I think the S&P 500 is still going to climb a little bit higher before it runs into critical resistance because it has a lot of other sectors that are lagging behind. Remember, when we look at a bull trend, we want to see the tech companies leading the way higher, and that is exactly what we've seen. And now to confirm the bull trend, as the tech sector is cooling down, we need to see performance and participation from the other sectors. Those other sectors we're going to focus on today are the financials, industrials, and the healthcare sector. So looking at this daily chart of the S&P 500, I think there's a very good chance as soon as next week we are going a little bit higher to fill this weekly gap, which is right at SPX levels of 4218.7. If I quickly flip this over to the weekly chart, you can see that is an unfilled gap going all the way back to August of last year when we started to get the impulse of selling. We gapped down and we have never gone all the way back up to fill that gap. And as you can tell, based on the weekly chart, we are very close to filling that gap. So in my opinion, there's almost a guarantee we are at least going as high as 4218. Now on top of that, we're breaking out of the bear market resistance trend line and we do have higher lows and higher highs on the weekly chart. So we are in a bull trend. And if the big tech companies in the tech sector are leading the way higher and the S&P 500 has lagging sectors, we would expect to see the SPX going all the way up into the 4300s next. As the tech sector cools down and goes sideways or slightly down, I would expect to see those other sectors start to rally and start to get positive cash flows, which is going to push the S&P 500 higher. So in the very short term, I think the SPX is going to 4218 and very likely going to continue grinding higher all the way up to 4300. I say grinding higher because if the big tech companies are cooling down, it's going to be difficult for the SPX to rocket higher. Now, just to illustrate this, I'm jumping over to the Dow Jones Industrial Average Index, which is the DJI, and you can see year to date, the Dow Jones is actually down 0.16%. Why that's so significant is because year to date, the NASDAQ 100 is up over 30% and the S&P 500 is up about 9%. Why that's so significant is because year to date, the NASDAQ 100 is up over 30% and the S&P 500 is up over 10%. So without a doubt, a lot of those financial and industrial companies are dragging down the S&P 500 and a lot of those big tech companies are helping the S&P 500 climb higher. That is very evident when you look at the Dow Jones and see that it's negative year to date, while the big tech companies in the NASDAQ 100 are up over 30%. So if we jump over to the NDX, you can see we're going parabolic as we reach that 61.8% retracement, which is exactly why I'm telling you I'm getting bearish on the big tech sector because I don't think we're going to see a lot more upside without a significant cool down. That doesn't mean I'm bearish long term, it just means short term because after the correction in the NDX, I think we are going to continue to go higher. Again, if this is a bull market, eventually we expect to break through that level, and from Friday's close, that's only about another 0.4% higher before we run into critical resistance. So in the big tech sector, even if we go higher in the short term and get a little bit of a short squeeze above that level, I still think we're coming down to lower prices in the month of June. So when I say short-term bearish, I'm talking about the next month outlook, which is only about 4 more weeks from Friday's close. So I'm not talking about some major stock market crash, and I'm not trying to scare you out of your positions. I'm simply telling you to be warned, to be cautious, that the big tech companies are likely going to get a pullback, get a correction, and come down to lower prices. Doesn't mean I'm right, and of course if we start to break above that level and hold it as support, then we're going to take away the parabolic condition and we can continue to climb higher. So just to illustrate that, there is the possibility we go through some type of little bit of consolidation as everything catches up and then continue the bull trend. However, if that happens, we're going to have plenty of time to see it, and there's still no reason to be overly bullish if we're just going sideways. So again, there's never my intention to scare you or try to make you short the market if you don't want to, or even panic sell your positions just because some guy on the internet has an opinion. Remember, we follow price action and trend, and this is still a very strong bull trend, I simply think it's gone too far too fast and due for a cool down. So let's move on from the NDX because I already did a very detailed video on that on Friday and I don't really think there's much more to talk about than what I've already said. So jumping back over to the S&P 500, keep in mind I think there's a good chance we're going higher, even if it's only to close this gap or test this resistance trend line right around 42.55. I think there is a chance the SPX grinds higher towards the 4300s, even if the big tech companies are cooling down and going through a correction. It is going to be very difficult, but not impossible. And the way I'm going to illustrate that is by charting the SPX against the NDX, and you could see this is just charting relative performance. This is in a very powerful downtrend where the SPX relative to the NDX is actually in a bear trend below a negatively sloping 200 daily moving average and a negatively sloping 20 period moving average. This is telling you that all of the performance in the SPX is due to the power in the NDX. So you can very simply understand how a simple reversion to the mean or back to this resistance trend line could mean the SPX is going to outperform the NDX over the next coming month. There is nothing subjective about that. It is 100% objective that the S&P 500 could start to outperform the NASDAQ 100 in the month of June. Again, I'm supplying you objective evidence. This is not just my opinion, and even though it doesn't guarantee it's going to happen, I'm giving you compelling evidence of why I think the S&P 500 could start outperforming the NASDAQ 100. So then on top of that, we need to go look at some of the sectors that make up the S&P 500, and the first one being the tech sector is the XLK, which is exactly what you're seeing in the NDX, so there's nothing new to look at here. The next major sector is the financial sector, and you can see price action is in a bear trend below the 200 moving average, below the 20 period moving average, and making lower highs and lower lows. So the only way the S&P 500 is going to start juicing to higher prices while the big tech companies cool down is if we start getting participation from the financial sector. So for that reason, just watch XLF and instantly get more bullish if the XLF can start breaking out above 33. If it's not breaking out above 33, there's a good chance this is a lower high before the next lower low, and that's going to tell us we're going to much lower prices because the S&P 500 is not going anywhere without the financials. So if these sectors like the financials continue lower, there is a very good reason to be bearish on the market as a whole because the tech sector can't do all of the heavy lifting forever. Remember earlier I said if the big tech companies are leading the way higher, we need to eventually see participation from these other sectors, which means we need to see sectors like the financials breaking out and starting to make higher highs. You are going to get all of the information you need to make that decision from following the price action because as I just said, we need to see XLF breaking above 33. So go put XLF 33 on your chart and instantly get more bullish if XLF starts breaking above that resistance. However, until that happens, there is no reason to be bullish because we're still in a downtrend of lower highs and lower lows, which is evident by the chart. So I'm trying to make this very simple for you and very objective for you so that there's no guessing. Simply wait until XLF is above 33 before getting more bullish on the S&P 500. One of the other major sectors is going to be the industrials, which is the XLI, and you can see XLI is currently sitting right on top of the 200 daily moving average, and we need to break all the way back above 100 to get more bullish. So in the industrials, this is a lot of the driver of the Dow Jones. We need to see the bounce off of the 200 daily moving average, and if we break below the 200 daily moving average, that is going to be extremely bearish. So in the industrials, you're instantly getting more bearish if we break below 97, and you're instantly getting more bullish if we could start breaking out above about 100 to 101. So again, this is all objective. Put these levels on your chart and then let the price action do all the talking from there. And then last but not least is the healthcare sector. And the healthcare sector is also looking bearish, trading below the negatively sloping 200 daily moving average. And for all we know, this is a lower high before we come down here and put in the next lower low. Now there is the possibility this could still be a higher low before the next higher high. And that would go hand in hand with what we're seeing with the big tech companies leading the way higher. If big tech is leading the way higher, we would expect the healthcare sector to put a higher low in and then just consider it as a laggard that is lagging behind the big tech companies that are leading, and then we're going to see the healthcare sector leading next. So the way I would trade the healthcare sector is you could simply draw your resistance trend line and wait for the break of that resistance, because if we get back up to that resistance and still get rejected, we are still on a bear trend. So you need to understand a lot of these decisions are always based on following price action and trend, which is exactly what I always tell you and exactly what I always teach you to do. You don't need to make any impulsive decisions. You can wait and let the chart do all of the talking. And once the chart does all of the talking, you should have a very clear idea of where we're going. As you can tell, there is a lot of uncertainty uncertainty right now because I am giving you both scenarios because even I don't know what's about to happen. If you're not willing to wait for the chart to expose where the move is going, you are going to do a lot of guesswork and you are going to lose a lot more trades and you are simply just going to have a more miserable time trading. So I am 100% completely fine sitting here telling you that I don't know what's happening and I need to see more price action, but at least I have very clear levels on the chart that I'm watching so that I know whether we're going higher or lower and I don't have to guess. You have to remember in trading, sometimes sitting in cash is 100% okay, and yes, cash is a position. If I'm sitting in cash, I'll have dry powder, and then I know exactly how to put that dry powder to work once the chart starts telling me where it wants to go. Both of these scenarios I just drew on the healthcare sector are completely valid, and both of these scenarios can lead to massively different results on how you trade this market. If the healthcare sector is breaking down and going to lower lows, or if it's breaking out and about to test 52-week highs, that is something I need to know, and only the chart and the price action can tell me next. So be patient, know these levels, and wait for price action to confirm where we're going, and then place your trade accordingly. Whether you want to short the market or go long is always going to be determined based on these critical risk levels and where the chart is currently going. Trade what the chart says and not your bias, and you're going to do very well. And do not forget what I told you about the SPX trying to climb towards 4,300 as long as we're sitting here trading above the rising 20-period moving average. Price action should do all of the talking, you should do no guessing, and the only way you should start getting bearish on the S&P 500 is if we start to break down below a lower low, which is going to require this breakdown below about 4,100. Below 4,100, we're likely going to see major damage in the market and we're likely going to much lower prices, but we cannot guess it's going to happen. We need to let the price action confirm it. So don't forget to take advantage of those Memorial Day deals where you can get 50% off the Stocks Channel Trading Discord community and Bank Trade Alerts. And don't forget TrendSpider is also doing a 7-day free trial period and up to 50% off their plans as well. So thank you for watching, everybody. I hope you're crushing this market. And as always, I will see you in the next episode.